In this week's market update, sterling is unsure which way to go as Brexit's crunch week arrives, while stock market's New Year rally loses momentum. With less than 3 weeks to go until the scheduled date for Britain to leave the European Union, no one, it seems, is any the wiser about what is actually going to happen. More than ever, whatever is said or written at the moment needs to come with a warning that it may very soon no longer be the case. What does seem certain, however, is that some key decisions will be made this week, one way or the other. Theresa May has promised a second vote by today, Tuesday, on the withdrawal agreement that was comprehensively rejected when MPs voted on it in January. With little apparent progress on improving that deal in increasingly acrimonious negotiations in recent weeks, the conventional wisdom until late on Monday evening said the deal would once again be voted down in Parliament. Then, as tends to happen with EU negotiations, an apparent breakthrough was announced. Mrs May claims she has secured a guarantee that Britain will not be trapped in a customs union by the so-called backstop. It remains to be seen whether Northern Ireland's DUP or the Eurosceptics in the Conservative Party agree that she's done enough to allow them to vote for the deal. What happens next is anyone's guess. Officially, the Prime Minister has said that a defeat in the Commons today will result in a second vote by Wednesday on whether or not to allow a no-deal exit or to take it off the table. Having already indicated an unwillingness to support such a cliff-edge exit in an earlier indicative vote, it seems extremely unlikely that MPs would approve such a risky move this week. That, theoretically, leads to a third vote by Thursday at the latest on whether MPs would instruct Mrs May to go back to the EU and request an extension of the Brexit timetable. Here, though, there's rather less certainty about the outcome. Mrs May has indicated that she doesn't want an extension at all, and certainly not one for longer than 3 months or so. The EU has said it would only approve an extension if Britain were to pursue a fundamentally different course of action, such as a second referendum, a different, softer Brexit approach, or an election. Whether we even get to all three of these votes remains unclear. It does at least look now that the first vote will take place today. There was some doubt about this just yesterday, and Mrs May has form when it comes to promising a vote and then snatching it away. However, it seems quite unlikely that if she is defeated in this first vote, that she would sit through the humiliation of 2 further defeats in 2 more days. The calls for her to make way for another leader are mounting, so it is entirely possible that she won't even see the week out as Prime Minister. Now, by a curious quirk of parliamentary timing, the Chancellor, Philip Hammond, is preparing to deliver his spring statement, right bang in the middle of the proposed parliamentary drama. He'll make the set-piece fiscal and economic announcement on Wednesday at lunchtime, assuming that events don't conspire to make the statement irrelevant. As it stands, no one is expecting much in the way of new policy measures, but the statement will still be significant as it will contain new forecasts for the economy and for the public finances. The outlook for the UK economy is pretty mixed right now. That's unsurprising given the scale of uncertainty thanks to Brexit, which has hit business investment and consumer confidence. As a consequence, output has ground to a halt, ending Britain's pre-referendum run as one of the strongest economies in Europe. In the final 3 months of 2018, output rose by just 0.2%, and the Office for Budget Responsibility is expected to trim its 2019 growth forecast from 1.6% to maybe as little as 0.8%. The UK has avoided the recession that many predicted in the wake of the referendum, but it's coming perilously close 3 years on. The flip side of lower growth is lower inflation, which is providing one of the positives for the UK economy. With employment proving resilient and wages rising at more than 3% a year, real inflation-adjusted incomes are actually improving at the moment. The jobless rate is lower than at any point since the 1970s. The other good news for the Chancellor to focus on is the relatively healthy state of the public finances. Tax receipts have been stronger than expected, driven by improving pay for Britain's highest earners. That should mean that Mr Hammond has even more in his back pocket than he thought at the time of his October budget. Back then, he held back £15 billion as a kind of insurance policy against a disorderly Brexit, and many believe he will start to spend this whatever the outcome in the Commons this week. Perhaps the one thing that we shouldn't expect tomorrow is the Chancellor delivering on his promise to set an overall path for public spending for 2020 and beyond. He will probably argue, with some justification, that a forecast that far out is meaningless, given the fact that we don't even know what things will look like at the end of the week. The market reaction to the Brexit saga has been relatively calm and considered. The post-Christmas rally has broadly continued. More recently, a modest slide in the value of the pound has helped share prices, which in the FTSE 100 at any rate tend to move in the opposite direction to the currency. But the pound is all over the place this week, moving in line with expectations about the eventual shape of Brexit. At $1.32 overnight, the pound has in the past few days fallen from a high of $1.33 to well below $1.30 and bounced right back up again. Not everyone in the world's financial markets is fixated on Brexit, of course, and elsewhere shares have been slipping over the past week as investors have focused on an apparent weakening of the US employment market, on worrying noises from the ECB, and on a dramatic slide in Chinese exports. Again, though, all of that changed overnight, with hopes of a trade deal between the US and China rising again, and the Brexit situation, of course, improving. So Wall Street broke a 5-day losing streak on Monday, while markets in Asia were also strong last night. It remains to be seen whether the mood has changed sustainably. Last Friday's non-farm payrolls employment report was notably weak, with new job creation of just 20,000 positions, comparing with expectations of about 180,000. Even that would have been well below the prior month's 300,000 new jobs. All of which suggests that the ongoing trade spat between America and China may well be starting to bite in the US. It's certainly starting to impact growth in China, where Premier Li Keqiang admitted at last week's National People's Congress that external influences, in other words American tariffs, were beginning to bite. Growth for China was downgraded from the last 2 years' 6.5% to a range between 6 and 6.5%. Now, while that would be growth beyond our wildest dreams here in Brexit Britain, it represents a continuing slowdown in the world's biggest emerging market. The biggest indication of the negative impact from the trade war, however, was last week's collapse in exports. The 20.7% fall was the steepest in 3 years and 4 times worse than the decline predicted by economists. Imports also fell by 5.2%, resulting in the smallest trade surplus for China in nearly a year. As a consequence, Chinese stocks recorded their biggest intraday dip since October, with the CSI 300 index down by nearly 4% on Friday. In addition to the slide in exports, investors ran for cover after an apparent cooling in expectations that the trade dispute would soon be resolved. Donald Trump and his Chinese counterpart Xi Jinping were due to meet at the end of March to sign a deal, but that date has been pushed out as both sides worry about the impact of a failed summit in the wake of Donald Trump's failure to do a deal with North Korea's Kim Jong-un. Meanwhile, in Europe, Mario Draghi at the European Central Bank poured cold water on hopes that the region is on a sustainable recovery path at last week's meeting of the ECB. Draghi will leave his post in November, having never raised interest rates during his 8-year term, a sign of the deeply entrenched growth problems in Europe. The one thing that we can be certain of at the moment is the fact that everything will look different by the end of the week. As the Chinese like to say, we live in interesting times.